All right, now that you've finished your spreadsheets, okay, and got those all done, it's time to write a narrative about those. Generally speaking, what I say about the narrative is it should be clear enough and have enough information in it that I don't necessarily have to even look at the spreadsheets. I know that sounds redundant, but really it ought to, and it ought to provide the background for a lot of this information. Okay. That said, you also have to be careful. Give you an example. Later on when we get to the management organization section, you're going to tell me about what your employees are going to be doing, what exact hours they're going to be working, their shifts, those types of things. So you don't tell me that in the financial narrative, but it's okay to tell me that you've hired X number of employees for certain shifts. You can sure tell me the shifts. Okay, so keep it based on the financials. But if you look at the template kind of that I have, or the Word doc that's in there, under there, let's go take a look. The business plan for a startup. This is one that I downloaded, and it's reasonable, but it's maybe missing a few things. But certainly you can approach this by going to each of the spreadsheets. So tell me about the starting point, right? Where do you get these numbers? Okay. You don't have to list because I've got that. Maybe you had a spreadsheet that listed all the numbers. Make reference. That spreadsheet is going to be in the appendix, so you can certainly, and you should, make reference to that. At this point in time, you might say see appendix, leave a blank, because we're probably going to number your pages, do those types of things later. Okay, you may want to highlight that or something so that you have an idea later when you go back that you need to input that information. Same thing with furniture fixtures. Anything where you might have a lot of items, you don't need to list all of those. If you only have a few items, it's perhaps okay to tell me about it from the financial standpoint. Again, maybe you're buying one building. You can tell me about it, a little bit. We're buying, it's located here, X number of square feet, et cetera, et cetera. It comes equipped with this. We're going to have to, make these types of improvements to it. If you're renting, you could say these are the types of leasehold improvements that we're going to need to make to that property. And you come down to the salaries, the pre-opening salaries. We're going to pay 3 people to help out for, 8 hours a day for 2 weeks prior to opening. You come in, we got to do a little remodeling, put up shelves, those types of things. Okay. Legal and accounting fees. Who are you going to get those from? Your inventory, what that's going to be. Prepaid insurance, again, where you got that information from, right? Who's going to carry your insurance, or at least who has given you quotes at this point in time. So explanations about all of those. Payroll, right? This stuff down here is kind of automatic. You don't need to discuss it a lot. Just briefly, how many employees you're going to have, etc. What kind of raises you're going to give them in the second and third years. Sales forecast. Again, this you do need to break down and be maybe as specific as you can. I've made note on several of the projects that, and maybe I didn't on yours, but you may want to take a look at it. Make sure the math works. Okay, make sure the math works, and by that I mean we're going to sell, X number of cups of coffee per month. 1,000 cups of coffee per month. Well, let's see. If we're open 6 days a week, we're going to be open 25 days roughly per month. So I got to sell 40 cups of coffee a day. Is that reasonable? Maybe. Okay, maybe. But if you got 10,000 cups of coffee in a month, it's probably not reasonable that you're going to sell 400 cups of coffee each day. So you kind of go through that math, make sure that it's reasonable, make sure that, if you've got one part-time employee, that they're going to be able to handle that type of a load. I will certainly do that math. At this point in time, I've kind of done some of that in my head maybe a little bit, and that's why I've given some people some feedback that says, you might want to go back and check those numbers. Talk about your growth rates. Again, a lot of this is automatic, so the second and third year you don't really have to tell me much about, just about your growth rates. And the additional inputs, Pretty brief, but if you've changed your accounts receivable, and most of you should have, right, based on how you're going to be receiving that, you can tell me about that. Same thing, maybe a little bit with how you're going to pay. If you've got some capital items that you're expecting to buy in the future, either later this first year or in the second or third year, that absolutely you should tell me about that. You don't really need to bother with the tax and the amortization. I've told you what those are and why we're doing that. When you tell me about the entity that you choose when we get to that portion of the thing, that'll make sense anyhow. So you don't need to really discuss that portion of it. Operating expenses should give me a fairly detailed account, especially of this stuff that's up here in orange. Although when we get to marketing, you're going to really detail the advertising. So at this point, it's okay to tell me you're just spending a little bit, right? Car and truck expense. Again, do the math. Okay. If you don't show a vehicle for the purchase, okay, I'm going to assume that you're going to be about 50 cents per mile is what the government says it costs you to run a vehicle. That's what you'd pay a lease. If your business is, for example, using your personal vehicle, technically you're leasing that vehicle to the business, okay, about 50 cents a mile. So if you're projecting that your car and truck expense is going to be $100 a month, that means you can only go 200 miles. And depending on the type of business, that may be reasonable or not. So make sure you do the math on those. And kind of explain briefly, what some of these other costs or how you came up with those cost estimates. Again, years 2 and 3, not a lot you have to tell me about. We're just projecting some, inflationary increases, that type of comment maybe, unless you have something that's a little out of whack or different from kind of what's on here. Cash flow. Again, the main items that you would talk about here are the ones that are going to be in orange. Okay? Owner's distribution, why are you taking that amount? Hey, we're projecting that we're going to have a line of credit for this first 6 months, but we should be able to start paying it off after that and have it completely paid off by month 8 or month 10 or whatever that case may be. Dividends, nobody's a C Corp. We're probably not going to be a C Corp, so you wouldn't actually pay any dividends. So you've really got 3 things there to talk about and how those might carry over again to years 2 and 3. Income statement. Now this is going to be important, and we haven't talked a lot about the income statement because it's kind of done automatically. But you need to take a look, at your bottom right-hand corner here and talk about what that net profit or loss is. If that's not a good number, you may have to go back and do some adjusting either on your expenses or your sales forecast, right? There's only a couple things that can change. Either you can increase your sales or you can reduce your expenses. So you need to take a look at what's reasonable in that regards. And I've made some comments to some of you. I, maybe even gave you a grade, but I said, I'm a little bit worried about your expense side, especially your payroll for a number of people. Or I don't know if your sales forecast is enough, or in some cases it's too much, right? That's the other red flag that I would look at. If you came in with a projection, if you're going to have a coffee shop, let's say, and your projection is that you're going to make $150,000 in the first year, I'm probably going to say, yeah, right? Or I won't say that, but I'll go back and take a look. So take a look at this and make sure that it's kind of a reasonable expectation. I'm all in favor of businesses doing extremely well, don't get me wrong, but I also found, and I found this in banking too, that a lot of the projections are way optimistic, and some too pessimistic, and so you gotta try to find a number here, or you should find a number here that's going to be kind of reasonable, and same thing for your growth rates. Okay, the balance sheet you don't need to talk a lot about, right? The things that you would talk about on here, probably the only things that you would talk about that are going to be important, maybe the increase in total equity, right? We're gonna be increasing our equity because the business is doing well. Boom. Maybe decreases in debt, okay? Especially long-term debt. That's important that you're able to reduce your debt, and it's going to go down, significantly or not, whatever the case may be, over the first couple of years. You may talk about the increase in assets. You might talk about an increase in cash. Those are going to be important things, but probably not a lot. You don't have to tell me that you balanced. I can see that. If you don't balance, then you'll get this kicked back to you. So, break-even points I love. Difficult to do on a service business because oftentimes service businesses don't have a cost of goods sold. And you can see, you got the margin there. One of the groups is doing an auction, for example. They do, right? Maybe their commission's basically 10%. So in a sense, their cost of goods sold is 90%. It's not what you'd call it, but we can call it that, right? And their margin kind of is 10%. So they could certainly do a break-even point and should. Everybody that can, and if you struggle with this, let me know. I love break-even points, and I loved them as a banker because it gave me, no matter what this income statement showed, the break-even analysis gave me a lot more, a lot better number to really see and look at to see if it was realistic or not. They might project $1 million profit in that first year, based on $3 million in sales, but if I could see that they could break even with $500,000 in sales, I might have found that to be all right. You may take a look at these financial ratios. A lot of these should fill in on their own. Okay, you could certainly look up industry numbers if you'd like to, but some of these might be important. Take a look at those, and if you find some of these to be important, report on them. Okay? Let me know if you got questions about it. Let me know. I don't think much on there. Your cost of goods sold, if you're in some manufacturing or whatnot, again, talked a little bit about that. And if you use this form, yes, you should talk about it. I don't know that I would discuss your amortization and depreciation to speak of unless you have something that's out of the ordinary, but most of you will not. These are fairly self-explanatory. That's kind of it then. That should be it. You should, a few pages, right? The financial narrative ought to be a few pages. You ought to go through, each of these statements. Again, the second and third year sometimes maybe don't require a lot, but you ought to go through those and explain the background into those. Don't just give me the numbers. Give me the background, the why you came up with those numbers, why, why your car, let's go back and look at that one, sorry. On your operating expenses, why your car and truck expenses are only $100 a month, because we're only going to drive, 200 miles per month. That's all we need. So explain those whys when you work on this particular narrative. Thanks and good luck.